But the old ways of doing things may actually be structurally flawed. Many long-term investors are waking up to find that their monthly dividend income is costing them a lot. The decay of their actual principal, their cost basis. Now, if you're like me, I used to have a traditional covered call ETF, QYLD, and just recently I did switch over to a NEOS ETF, but that brings us to the biggest mystery of all between traditional covered call ETFs and NEOS ETFs. If you look at their tax documents, you will see that they show that their cash payouts are ROC, return of capital.
Wait, Shell. If both funds are using return of capital, doesn't that mean both of them are just handing me a refund of my own original money and lowering my cost basis?
There is a main difference, Henry, between the two ROCs. One is destructive and one is constructive. Are NEOS ETFs like QQQI and SPYI the actual future of dividend income investing? That is the question that Henry and I will be delving into in this video. Covered call ETFs have completely changed the way everyday people build monthly income. But the old ways of doing things may actually be structurally flawed. Many long-term investors are waking up to find that their monthly dividend income is costing them a lot. The decay of their actual principal, their cost basis. But the new type of actively managed funds, NEOS, are claiming that they have solved this problem entirely. Henry and I will be breaking down the exact differences between these two by discussing how they utilize ROC, return of capital, and how to choose the right one for your financial goals.
Shell, a covered call ETF is a covered call, right? You hold the stocks, you sell the call options, you collect the premium cash, and you buy sunflower seeds.
It all comes down to which options they sell and how do they manage them, Henry. A traditional covered call operates on what's called legacy rules. This means that they follow a computer automated script without deviating from it every month, despite what the market may be doing. And part of those passive rules means that they sell at the money call option. Let me go in a little bit more depth with the Amazon shopping analogy to help explain legacy rules. Imagine you are scrolling through Amazon shopping and you see a hot new cell phone is going to launch, but you can pre-buy it right now at the cost of $100 and you'll get a rebate of $10. So you do it. You click that buy option. That is at the money sell. You give up any possible better price for the phone for your rebate now. Now, to give it a little bit more clarity, let's look at this as that you are the seller and how does that look on your end. You sell your new phone to a buyer for $100 and you give them a rebate of $10. So now you have a net profit of $90. But if that phone suddenly becomes super rare, and the market value explodes to $150 next week, you don't benefit from that jump at all. You are legally locked into that $100 sales price. Traditional funds like QYLD, this is how they operate. As the seller, they give up the potential of a future profit to get that immediate cash right then and there. That's why sometimes the fund stays flat when the market is going up, and then when the market falls, it also falls. And this will lead to serious NAV decay over time. On the other hand, NEOS ETFs do not follow the strict legacy rules formula. They actually have actively managed portfolio managers doing the buying and selling. Let's go ahead and look at it through more of a shopping analogy. They see the exact same deal with the phones, but they decide not to hit that buy button immediately. Instead, they just keep it in the cart with a coupon that says they can buy the new phone at a later time with a better price.
Oh, I get it. Because the item is just sitting in their cart with a smart coupon, if the value of the phone shoots up, the store owner actually gets to participate in that value growth instead of being locked out.
Exactly, Henry. That coupon is called out of the money, and it creates a spread where it's like a buffer zone that allows the fund to grow before they hit the buy button. And with all this going on, they still pay those high dividends just like traditional covered call ETFs. But that brings us to the biggest mystery of all between traditional covered call ETFs and NEOS ETFs. If you look at their tax documents, you will see that they show that their cash payouts are ROC, return of capital.
Wait, Shell. If both funds are using return of capital, doesn't that mean both of them are just handing me a refund of my own original money and lowering my cost basis?
There is a main difference, Henry, between the two ROCs. One is destructive and one is constructive. Now I'm going to explain to you, Henry, and my viewers a little bit more about those. Now, with a traditional passive covered call ETF like QYLD, as we know, they use the legacy rules. Their return of capital is considered destructive. And the reason is because they have the pre-buy that they have to buy at the money. So if they lose money on that call option, they still need to pay their shareholders. And so what happens is they actually take some money from your principal, your cost basis, to help pay for your dividend income. NEOS ETFs actually do something a little bit different. And what they use is what's called tax loss harvesting, which is a legal tax shortcut. And so it ends up being more a constructive ROC, return of capital. Let's go ahead and go back to the Amazon shopping analogy to explain it a little bit more. Imagine you bought a defective gadget on Amazon that completely dropped in value. You decide to return it by selling it at a loss. You then take that loss and use it like a coupon to lower the final price of the full price premium items in your shopping cart. NEOS fund managers actively harvest these paper losses inside the fund. They pair those losses with the steady income that they get from their smart options. Because of this, the IRS allows them to label it as return of capital. Your tax bill is deferred, but your actual principal isn't being touched in order to give you this dividend income, because the monthly dividend income is coming from the smart option cells, and so it's from real income. That's why it's considered constructive return of capital. So how do you choose which one's right for you for your financial goals? It actually depends on what kind of account you are using. Are you using this in a regular investing portfolio, or are you using it in the Roth IRA? So when it comes to the type of investing, if you are in your regular investing, then your NEOS is going to be the one that you want to stick with, because they have definitely better tax rate than a traditional cover call ETF. NEOS utilize index options that are classified as 1256 contracts.
So that means 60% of it's considered long-term capital gains tax versus 40% short-term capital gains tax.
And so that's better than traditional cover call ETFs, which have a higher tax rate because it's considered non-ordinary. Now, if you decide to just have these funds in your Roth IRA, then the taxes, it doesn't make a difference, because that's tax-free. But what you do have between the two is cover call ETFs
has a little bit lower expense ratio, about 0.6%, whereas NEOS is about 0.68%.
You're paying a little bit more in fees, but they don't come out, like you don't have to actually pay them, they just come out automatically and you never see that. Also, the benefit of NEOS is that you do have where you can have growth also on top of the high dividends. And the dividend rates are pretty much equal, so they're about the same. So it really depends on where you have it and which one you like better. Now, in the past, if you've been watching, I used to have a traditional cover call ETF, QYLD. And just recently, I did switch over to a NEOS ETF. And so if you're kind of interested in finding out like why I did that or how I did that, definitely check out this video here, and I share with you all that information. Now, if you watch the very end, thank you so much. Henry and I, really do appreciate it. Until next time, bye.